What is the difference between barrier funds and buffer funds? Buffers are non-contingent. The buffer will always be in place regardless of the performance of the underlying asset. So if the underlying asset is down 30% and the buffer is 20%, the fund will be down 10% at expiration. Any benefit from the barrier is contingent upon the underlying asset remaining above the barrier. If it drops below the barrier, the fund is fully exposed to the downside. So if stocks are down 30% and the barrier is 20%, then the fund declines by the full 30%. The contingent nature of the barrier is why a fund with a 20% barrier will have higher income than a fund with a 20% buffer. What are the best or worst environments for sbar and XV? On an absolute basis, the worst return will be when the worst of asset return drops below the barrier at expiration. The absolute best returns will be when the worst of asset return remains above the barrier at expiration. On a relative basis versus a regular equity fund, the worst environment will be when stocks have a very strong year above the amount of premiums earned. The best relative performance will be when equities are down a large amount, but just above the barrier. In that case, there could be a dramatic difference in returns in favor of sbar and XV.